Hello and welcome to a Wealth of Advice market update on the 22nd of April 2022. The main news story still dominating is what's going on between Russia and Ukraine. Since our last update in March, although the war is continuing, it looks like it has changed somewhat in so much as the Russians are now focusing on the Donbass region. There's been some positive news from the Ukrainian side of it. They sunk a big Russian warship last week, and that's obviously having negative impact for Mr. Putin in Moscow, we believe. But as I say, it's still happening. From the point of view of world markets recovered after the initial invasion, and things kind of improved a little bit from valuations point of view. However, the last few weeks markets have been somewhat volatile. Even today on this Friday morning, we're looking, the pound has collapsed this morning against the dollar because fears of inflation and how that's going to affect consumers still weighs highly on markets. There's some key specific stocks around the world that we can see are really being affected negatively by the consumer not spending as much on certain items, because obviously the consumer is really worried with high inflation, high energy costs. They're not going to have spare money for other things. The energy sector is the big problem, and as I say, the US at the end of March announced annual inflation of 8.5%, which is just absolutely frightening, and that has been led by rising energy costs, food price and housing costs, and I think it's the same the world over. So what we need to see next is how various central banks deal with this. The typical way to deal with it would be to try and raise interest rates, but yes, we need to see what's going on with that. With regards to the energy, the US is releasing another million barrels of oil per day to try and bring down the oil cost. And if you do look at the actual oil price of Brent crude oil, the price did hit a high a few weeks ago. It's around about $106 a barrel right now. We need that probably closer down to $100 a barrel to get back to a level that maybe the market's like. So we're not that far away from that, and hopefully that means that inflation isn't going to be persistently high, but that is definitely the worry and the fear of the markets right now. So although many of the news stories you'll be watching and hearing right now do appear to be negative, we have obviously been speaking with various fund managers and so-called experts, JP Morgan being one who we had a chat with last week. JP Morgan actually believe most economies around the world are strong enough to withstand this energy shock and the increase in prices. And as I say, although the oil price per barrel went above $120, by releasing those strategic reserves in the US, for example, this is bringing the price down, which is good for markets. Manufacturing services sector both remain strong. Again, you're not hearing people losing their jobs around the world. If anything, there is still a labour shortage. People want to employ more people. JP Morgan said that they expect to see more financial stimulus in the coming months to hopefully again offset rising energy prices. I mean, on that point, you see in France, for instance, a lot of their consumers haven't been passed on all these increased costs. It's strange how in our country it has just been passed straight on. So our government clearly needs to do something about this. They can't let it persist forever. There's elections going to come up, council elections and such like, but then you've got a general election in 2024. So they're going to have to do something about it if they want to try and win votes. Most economists we speak to are forecasting that inflation will begin to reduce, and certainly in 2 years' time, certainly that was the longest you'd expect to see this high inflation remain, which is good. And when we mentioned earlier that interest rates will be a tool used by central banks, increasing interest rates will hopefully reduce inflation. One of the fears we've always had in the past that increasing interest rates will really negatively affect mortgages and those people who are paying monthly mortgage costs. But it's interesting to also know that less than 20% of UK mortgages now are on a variable rate, and less than 5% of US mortgages are on variable rates. That means most households now have fixed rate mortgage deals. Go back to 2005, 2006, before the last big property crash of the financial crisis, 2007, 2008. I was a mortgage advisor at that time, and I would have said it was less than 10% of people were taking fixed rate mortgages at that point. So that has gone full circle. So the government will know that increase in interest rates will not negatively affect many mortgages. So that's why they're likely to do that. And we're expecting interest rates to get to around about 2% by the end of this year. So everything that's going on in the world, the biggest problem that markets are now facing is inflation. The first graph that you can see on the left hand side of your screen, it talks about UK headline CPI. And as you can see, this has really spiked up all the way through 2021 as we've getting into 2022. So as I've said previously, those clients who became clients from November onwards have pretty much just seen fund values fall since November. Well, it's no coincidence that was when the CPI figures were really starting to go up, and then they've spiked, or the forecast analysts are believing they're going to spike in Q2 of this year before falling slightly as we get into the end of 2022, and then down to what we would hope is more normal inflation levels in 2023. Obviously it won't feel like that right now when you're thinking everything that you're buying and spending money on is going up in value or going up in cost, but then the graph on the right hand side will show US headline inflation rates and what experts are thinking that's going to be, and it follows the same pattern. All we can do is keep an eye on this, and hopefully, as I say, inflation will come down, and if that happens then the markets will respond positively. So when inflation comes along and inflation's going up and it's high, obviously all central banks around the world will want to keep inflation under control. The biggest tool that they have in their box to keep inflation under control is to rise interest rates. The theory being raising interest rates will reduce people's demand to spend money. So as you can see from this graph, all the major economies around the world, the US, the UK, Eurozone, we've even put Japan on this graph. Well, JP Morgan did, it's a graph they produced. You can see even Japan is looking to raise their interest rates this year. The UK has a target of getting interest rates up to 2%, but you can see there that the analysts are forecasting that if we get interest rates up to this level, the economy comes under control, there's a chance that interest rates might even reduce from 2% in the future thereafter. But again, these are all forecast projections, and we just have to see how the current year pans out before the reality comes through. So with everything that's going on in the world, rising interest rates, high inflation, clients are asking us, well, where can we make money? The simple answer of the matter is we have all portfolios, whether it's our model portfolios, the Royal London portfolios, are well positioned to hopefully benefit from everything that goes on at different times of the cycle and different parts of the world. The quilt that we can now see on the screen shows what was the best performing asset classes so far in 2022. And as I say, it's a mixed bag, and basically commodities that's what the abbreviation there is at the end. So if we had all of our client money invested in commodities at the beginning of the year, you'd be 25.6% up, which is clearly not going to be possible. We would never invest every client in that particular sector. It's quite specialist on its own, commodities in its own right. But everything else under that you can see is made a loss. So far in 2022, no matter which way you have clients' money invested, you would have made a loss on the vast majority of the asset classes so far. In the end of the first quarter has just gone past. We're now in the second quarter, and as we saw from the graph there about inflation, we're hoping that if inflation comes away in the second half of this year, then returns will start to increase from then. So this quilt that you can see on the screen right now shows the various stock markets around the world and what their performance have been during the Q1 of 2022. It's no surprise to see UK FTSE All Shares the only one that's actually in profit. Obviously you have companies like BP and Shell in amongst that, and a few of the mining and commodity companies which have done very well as we've entered this period of an energy crisis and high inflation caused by the war in Russia and Ukraine. You can see on there that the US S&P index is down at the end of the first quarter. We're now going to come on to a few individual stories about that and which stocks are doing well and which ones are doing really bad. So the first stock that we're going to look at, which has had a pretty terrible year, is Netflix. As we hear people around the world are not liking the fact that the cost of food, the cost of energy is going up. One of the things that everyone will be doing is saying, well, how can we cut costs and expense on things we don't need? So if you remember during the pandemic when COVID came, everyone was at home, had to work from home, everyone was on lockdown, you had no choice. More people were subscribing to streaming services, so it was no coincidence that the Netflix share price went up, and it went up very high. As you can see on this chart we've got on the screen now, only in the last 12 months, over the last 52 weeks, the highest share price that Netflix got to was $700 a share. As you can see now, when we printed this chart earlier, it was down to $218 a share. That's absolutely massive. That's 57% down over the last 12 months, and this is because so many subscribers are just cancelling their Netflix subscription. People have moved on from sitting in the house and binge watching series of things. You then look at which other stocks may do well. The Marble Special Situations Fund Manager, who was at our event at the Ramside in February, for example, was saying that he's investing in Jet2 stocks because obviously people will be taking more holidays this summer, and you would expect Jet2 stocks to do very well. So when clients ask what are the fund managers doing behind the scenes, you would hope that any fund manager who's held Netflix for the last few months has certainly sold it and didn't own it yesterday when it fell off a cliff yesterday, and are buying it with other stocks, which you're going to hopefully pick up as people get out and spend more money on holidays and other things outside the house. The next stock that's had a terrible year is Facebook. Their stock is held under Meta Platforms now. That was the new name Mark Zuckerberg gave for the company recently. And as you can see there, Facebook stock is down over 36% over the last 12 months. There was a particular dip that you can see at the end of January going into February, when I think around about $300 billion of the value of Facebook was wiped off pretty much overnight. That was on the back of a few bad news stories for them, mainly centered around Google and the European Union stopping data extraction from clients' Facebook accounts, which Facebook would then use to be able to sell to retailers, so that people who put adverts on Facebook would be able to target people more specifically. So as a result of that, there was a fear that Facebook's earnings were going to drop massively to the tune of billions, so there was billions wiped off their share price. Mark Zuckerberg is obviously wanting to turn on the fortunes of Facebook, and what you would say with that particular stock, there will be fund managers out there who will be looking at and thinking, is this a buying opportunity? Is this stock now at such a level where we should be buying in? And as I say, the sheer size of it and the cash flows that go into a company like this without many overheads really, you would hope means that this stock will recover and the performance will come back later on in the year and beyond. So the next two stocks I'm just going to highlight, obviously talk about the FTSE 100, FTSE All Share doing well. These two stocks are listed on the FTSE 100. The first one you've got BP, whose share price is up 34.5% over the last 12 months. And the next one is Shell, whose share price is up almost 61% in the last 12 months. Both of these stocks, obviously big, huge oil companies, were very much unloved the last year and the year before, especially 2020. World goes into lockdown, oil price dropped through the floor. The OPEC countries were saying it cost more to dig the oil out of the ground than what it would actually be to sell it. So oil was in a negative situation. Nobody would have wanted to hold these stocks. Certainly some of the funds that we invest our client money into, which would have invested in the FTSE 100, people would have seen that these funds were the worst performing funds out of everything, because if you're investing in the FTSE 100, you would probably have to invest in BP and Shell. Fast forward to today, and those funds with these stocks are the best performers around. Again, it just highlights the fact that over the long term, you've got to have a balanced portfolio that has exposure to all the major asset classes and all the major stock indices over the world. Will BP and Shell be the best performing stocks in the next 12 months? I just have no idea. That's where the fund managers come in, and they will simply buy in at these shares at what they think is a good price, hold them for the duration that they think it's a good investment, and then get out when they think the price may turn, and that's what we pay them for. So now we come to the part of the presentation where we look at the various stock markets, different indices and how they've performed so far. As I said at the beginning part of it, most things haven't made money this year. The FTSE 100 there is the blue line at the top, buoyed by Shell and BP. That's up 4.39% year to date. But the two indexes at the bottom that we always look at, the S&P 500 and the MSCI World Index, are both in negative territory. How long that will continue for, we don't know. But as you can see, the lines are quite bouncing up and down. It's quite a volatile time. I wouldn't be worried too much. I think there's many companies on there, like we saw with Facebook, whose share price may come back. But if you also look, Google, Apple, Amazon, Microsoft, Disney, all their share prices, which dominate the US index, all the stocks that we were saying during 2020 were providing that growth when we came out of lockdown. Those are very good companies with very good cash flows, and we do expect their share prices to recover and things to return, hopefully not too long a time in the future. And now when you stretch that performance of how these three indexes have done over a 12-month period, you can clearly see that the S&P is still one of the best, as it is over all longer term periods. The FTSE 100 is just about keeping pace with it, but the MSCI World Index is quite a way behind them all. Nothing to be worried about there. They all seem to be going in the same direction over the long run. And what we are more bothered about, as ever, just to repeat to any clients watching this, it's how these portfolios that we invest clients' money in over the long term perform. And this is our 5 model portfolios for the Wealth of Advice model portfolios have performed over 5 years. For those clients invest in other portfolios, they all look somewhere the same, where you've got that big dip in the middle for COVID. Everything's recovered thereafter. But if you look at the last 6 months, it hasn't been rosy, with the high inflation, interest rates going up, the fear of what's going to happen in Russia and Ukraine. But as you look at the very end of that graph there, you can see there was an uptick, which we saw from early March all the way back through, has come down again in the last few days. hopefully that come down is ready for another launch back up in the second half of this year if inflation can be kept under control. So thanks again for listening to the Wealth of Advice market update. If any questions or queries arise as a result of watching this, please don't hesitate to get in touch.